Taking a look at the start of trade yesterday, a subdued start to the trading week. We have the bourse down over 9% for the year. Just looking at volumes yesterday, they were down 14%, turnover down 21%. What do you think accounts for the market underperforming other Southern African markets?
Well, like we said earlier on, the problem with the Kenyan stock, the Nairobi Stock Exchange, is because last year we had started from a low base, and we were one of the best performing markets in Africa. But I think at some point the market was overbought, and you were bound to see corrections, and that is perhaps what is holding us back. Of course, the complications arising from issues like inflation, so that's perhaps why the market is behaving the way it is.
Just looking at those inflationary pressures, Kenyan Coble coming out saying that the energy regulator meeting on Friday, we could see an increase in the price of petrol by around 5.9 Kenya shillings. This is quite substantial given the fact that we already had inflation in April coming in at 12.05%. It was sitting just under 4% in November. So it's risen up dramatically. The cost of living is rising in Kenya. How do you expect the Monetary Policy Committee to respond to these inflationary pressures at its next meeting in May?
Well, I still expect more tightening. Never mind that the economy might have taken a couple of body blows because of the like you mentioned, inflationary issues. But I don't think they have an option, because when you have inflation locally and part of it is imported, you need a stronger unit, and therefore tightening is the best medicine at this point.
And as we see that Kenya shilling trading at around a 5-week low to the dollar, so not helping the imported inflation story there. Just looking at government issuing bonds yesterday, hoping to raise around 18 billion shillings. What type of demand do you see from the market for this paper?
Well, you expect quite a bit of demand, because the financial institutions are still liquid. However, accompanying that high demand will be a demand for higher interest rates, and perhaps that is why the government went for three bonds, each in everybody's preferred habitat, so that they can spread out and be able to offer everybody at least something. So in that way, they're able to take up the amounts that they want at the interest rates they want, so that they can, if it's too expensive, they take short-term debt. If it's if they can get good deals on the longer end, then they'll take that up as well. But they're looking to raise about 18 billion, and they're likely to raise that from the cheapest money available, because that's the way the auction works.
Let's just turn to the equity market. Banking shares have all been reporting their first quarterlies. Diamond Bank coming out with its results yesterday, a 64% increase in profits. Interest income rising to 1.3 billion rand. Assets are up by 23%. What did you take out of these results?
Well, it was probably expected, because compared to what they had for last quarter interest rates were still high, liquidity was a bit low in the market, so banks were not really that profitable. But this quarter, coming off 3 quarters of growth in last year, that was perhaps expected. Going forward is where the question lies now. But for now, banks will still be expected to do pretty well compared to the first quarters.
Equity Bank also had a strong first quarter. KCB reporting rises in net income and net interest income of around 30%. So strong quarterlies from those banks. Is the same expectation for Barclays and Standard Chartered also to come out with good first quarter earnings?
Perhaps not those two, because those two had their years, their 2010 was not that strong, and therefore the variance between quarters may not have been much, and they've been caught up in a situation where interest rates are rising. A company like Barclays had taken out time last year to modernize its its operations by buying a new ERP, and therefore perhaps they didn't do as well as everybody else was and what they expected to anyway. But I mean, this year compared to last year, I don't expect. I probably maybe 20 or 30%, and I'm talking relatively speaking. Of course, 20% is good, but relatively speaking, compared to other banks, I don't expect them to do too well.